Good evening, everyone. My name is Eleanor Ho. On behalf of the Secure Planning team, I would like to welcome everyone to participate in today's webinar. I'm sure that you all agree with me that it's nice and warm to sit at home, to enjoy a hot beverage, and then listen to this informative webinar. And then while it's 70 degrees out there. At the bottom of the screen, you can see that there is a box called Q&A. We appreciate that if you have any questions, please type into the Q&A box, and Wesley, our associate advisor, will monitor that and share the questions with our speakers, Brandon, later on, so that we make sure that we are on a timely schedule and then finish all the important information shared with everybody before we answer the questions. Now, without further ado, let me introduce my dear friends, Mr. Duncan McGuffey. We have known each other for close to 30 years. I don't want to date myself, but we have to, that's the truth. And then, thank you. Duncan is the division vice president of Prudential. He has been helping our clients and our team for many, many years. And then Duncan will help us to introduce our guest speaker, Mr. Brandon Buckingham, who is a very experienced and knowledgeable estate and tax planning attorney in the whole country. Duncan, please take it from here. Thank you.
Eleanor, thank you very much. And good evening, everyone. Eleanor is one of the smartest people that I know. And if you work with her and Wesley and Mihal and their team at Secure Planning Strategies, you'll know that they cover the gambit of all financial, legal, estate planning, market-driven activities. What I didn't know was she was the Farmer's Almanac, because when we talked about this last fall and we said, why don't we give a virtual workshop a chance? Eleanor said, that sounds like a great idea. And Eleanor, I think your timing was perfect with the weather. 17 degrees. I just ran up to the store for just a minute. There's nobody on the roads. It is icy and slippery. And the content that Brandon's going to cover this evening is really important because, of course, the government tries to get things accomplished on an annual basis. They usually squeeze some things in right at the end of the calendar year before they escape back home for the Christmas holiday break. And Brandon always takes that information and synthesizes it, puts it in really important and understandable terms, and then comes out and provides that content to our financial advisors, independent advisors across the country that work with Prudential. And then some of those very, very astute advisors say, let's share that content with our valued clients, which is exactly what the Secure Planning team is giving you the opportunity for this evening. But if we waited until March or April or May, it might be a little bit late. So here we are at the very beginning of February. As Eleanor said, we're all home safe, warm, and sound. And I can assure you the time that you're going to invest this evening when we wrap up with the Q&A a little bit later on will be time well invested. So thank you for joining us. Eleanor, it has been a complete honor and privilege and pleasure to work with you and your team now for almost 30 years. Brandon Buckingham is our #1 resource at Prudential. Brandon speaks at all of the big national conferences, all of the industry events. He brings in sellout standing room only crowds because of his history of delivering value, actionable content. And tonight he's going to talk about some of the changes last year, the One Big Beautiful Bill. What did that impact? What did that not change? A number of other topics that your team at Secure Planning will be integrating where appropriate into your financial, tax, and estate planning. And Brandon will be available later on in the program. As Eleanor mentioned, Wesley will be the coordinator of that. And then I know Mihal's going to wrap up the program. But it is our privilege to do business with all of the clients or many of the clients with Secure Planning Strategies. In many cases, you've made your clients our valued mutual clients. We take that responsibility very, very seriously. And we look forward to continuing to grow our relationship and asset management opportunities in today's marketplace where fees have been reduced dramatically. Market opportunity has been increased substantially. And whether you're investing for protection and growth or for maximizing and potentially increasing your long-term retirement income, Prudential has world-class solutions, and the team at Secure Planning Strategies are experts not only in our solutions, but all of the top providers and asset managers in our industry. So we do appreciate the privilege of working with your advisory team and being involved in this evening's program. So Brandon is joining us from his home in Boston this evening. It's no warmer in Boston, I'm sure. They've had a lot of snow out there, and it's been one of those real old school winters for the Midwest and the Northeast. Brandon travels about 40 weeks a year. We were going over his calendar for next week and the week after, typically 3 or 4 cities, again, bringing out value, content, and continuing ed for advisors, and in some cases for individual investment clients. Brandon's going to touch on a number of important topics, but feel free to go to the Q&A box and input your questions. And again, Wesley will bring those up at the conclusion of Brandon's comments. Brandon's a 27-year industry veteran. He started his career as an attorney in Boston at a very high-profile law firm as an estate planning specialist in a time where many, many Americans had estate plan and trust based on where the tax laws were at that time and the really substantial exposure to estate taxes for the majority of working Americans. Brandon then transitioned from that into being an ERISA specialist, so really a founder of many of the corporate plans and the corporate retirement and tax plans through ERISA. About 15 years ago, Brandon joined Prudential, and he has been the #1 draw and #1 content provider for our organization. Prudential is a 150-year-old company, headquartered in lovely Newark, New Jersey, $1.6 trillion in assets under management, extremely high financial ratings, and we are thrilled to bring value-added content through great partners like Brandon Buckingham. So Brandon, thank you again for joining us. To the entire team at Secure Planning, thank you for the opportunity this evening, and thank you for the privilege of doing business with you and your clients. With that, I'll turn it over to the head of our advanced planning group, attorney and senior vice president at Prudential, Mr. Brandon Buckingham.
Well, thank you, Duncan, Eleanor, Mayhole, Wesley, for this opportunity here. Give me 1 second while I pull up my presentation. I want to make sure that it's up. Do you see that? Perfect. So, hey, thanks everybody for taking time on this very cold Tuesday evening. It's not much warmer here in Boston. We're still contending with about 2 feet of snow. So it is very nice to be sitting in my home office inside. Hey, so today I want to do a presentation called New Goals, New Rules, New Year. As Duncan mentioned, every year, there are legislative changes. There are tax changes. I want to talk about high level what those changes are, how those changes could impact you, how it could influence some planning opportunities. And what I really encourage everybody to do here today is, I'm going to cover a lot here today. And, but, it's something kind of draws an interest, right? Jot it down. Maybe there's something I need to follow up with Mayhole, or maybe with Eleanor or Wesley, maybe something I need to talk to my attorney about or my tax advisor about. What I hope to do here today is really cover some of the more recent tax changes and how those changes could impact you. We'll talk about some recent changes to Social Security and Medicare. I will talk a little bit about the future of Social Security, the current health of Social Security, what changes we could see to Social Security. I'll give a quick update on some retirement-related changes, right? Some changes that could impact your 401k plans, your IRAs, and then some things to think about when you're doing an annual review. I think it's very important, at least once a year, whether you do it at the beginning of the year or the end of the year, do an annual review. That may uncover some opportunities. So let me just start off with tax changes. As Duncan mentioned, last year we saw new legislation called the One Big Beautiful Bill Act. That was signed into law last year. It passed the House by 1 vote, and it passed the Senate. Well, it was a tie vote in the Senate, with the vice president being the tie-breaking vote. So I'm going to talk a little bit about some of those changes, tax-related changes, and how that could, again, impact you, maybe, influence some planning opportunities. So let's kind of jump right into it. So a little over a year ago, before this legislation was signed, President Trump was really talking about, well, during the campaign, President-elect Trump was really talking about a couple things. One was his promise to make tips tax-free. And I think initially people were concerned, okay, well, if that happens, what's going to stop every single employer from restructuring their compensation package so more people are paid in tips and less are paid in a taxable uh, wage? Just real quick, this really only impacts those uh, clients that are paid historically in tips. So kind of think about wait staff at a restaurants. And it's only tax-free up to $25,000 of reported tips. So that's assuming they're reporting all their tips. And then once their income exceeds a certain threshold, this benefit goes away, and this benefit will go away at the end of 2028. So this is temporary. But by the way, the biggest change in the One Big Beautiful Bill Act, in my opinion, was really no change at all. Some of the biggest changes in that legislation was really extending and making permanent some of the key tax provisions of the Tax Cut and Jobs Act, which was passed, almost 9 years ago. So that means keeping the top tax rate at 37%, keeping the standard deduction as high as it is, keeping the AMT patch around. And I'll cover a couple of those in the near future. But there are other provisions like this one here, no tax on tips, that are temporary. Another campaign promise was we're going to make Social Security benefits tax-free. I want to be very clear here, and I think there's still confusion out there. Social Security benefits are not tax-free. They used to be. They used to be until 1983. Under the Reagan administration, they introduced a tax on certain benefits for certain retirees as a way to kind of extend the solvency of the Social Security system. Right now, about 40% of retirees will pay some type of tax on their Social Security benefits, depending on what their income level is. There was a concern, hey, if we made these benefits tax-free again, this could accelerate the depletion of Social Security. And right now, as we speak, Social Security, the so-called Social Security Trust Fund, if we don't see any changes, could very well be depleted by 2032. So was that 7 years, 6 years from now, 2032, 2033. But with this particular campaign promise, making the benefits tax-free again, any changes to Social Security cannot be passed through what's called a budget reconciliation process. And not to get too technical, that's exactly how this legislation was passed. In its stead, Social Security benefits are still going to be taxable depending on what your income level is. But in its stead, there was something else that came by way of this legislation. And this is referred to as the senior deduction. So anybody who's over age 65, they're entitled to an additional deduction of $6,000. Married couple filing jointly, if they're both over 65, well, then that's $6,000 each, so $12,000. This would apply, by the way, whether or not you are filing for Social Security. This would apply whether or not you take the standard deduction or your itemizer deductions. Now, when your income exceeds a certain level, this deduction, this $6,000 deduction, will be reduced if your income's over 75,000 as a single filer, 150,000 as a joint filer, and then this goes away completely at the end of 2028. And I'm going to show you a quick example how this works. But again, for those over age 65, this could be a pretty big benefit. And it started last year. So as we get geared up for tax prep time, which is right around the corner, you may see a difference in your tax liability if you're over age 65 as a result of this new deduction. Something also that's new. Now, to take a charitable deduction in the past, you had to itemize your deductions. Well, right now, most people take the standard deduction because the standard deduction is so much higher than what it used to be. Now, for those that do take the standard deduction, you're entitled to a charitable deduction of $1,000 for single filer, $2,000 as a joint filer. So for those that take the standard deduction who are otherwise charitably inclined, this could be an additional benefit that could potentially reduce your taxable income. These are the tax rates this year. So top tax rate is 37%. If we saw a sunset, which again, that was originally going to happen before the legislation passed last year, that top tax rate would have gone up to 39.6% this year. It didn't. It stays at 37%. You'll notice that the tax brackets will change from 10, 12, 22, 24, 32%. One thing I want to draw people's attention to. Let's assume you make $100,000 as a joint filer. That's going to put you in the 22% tax bracket, but that does not mean all your income is taxed at the 22% rate. It's a progressive tax system, which means as a joint filer, if you look at this chart, your first 25,000 or so will be taxed at the 10% rate. And then your income between 24,000 and 100,000 at the 12% rate. So whatever tax rate you're in doesn't mean that's what you're paying on all your income. Capital gain tax rates. So if you have a long-held capital asset, if you hold it for at least a year, so think about a mutual fund, think about stock or real estate. If you hold that on for at least a year and you sell it, you're going to be taxed not at ordinary income rates, but at capital gain rates. And the capital gain rates for most will be 15%. If your income is above a certain threshold, it could be as high as 23.8%. But take a look at the 0% rate. If your taxable income as a joint filer is less than $98,900, so that's taxable income. You add the standard deduction, you're really looking at gross income at about $130,000. If you sell one of those long-held capital assets, you could be paying a 0% rate, right? So you won't be paying any tax on that. Now, it becomes a numbers game. The more assets you sell, it could push you above that threshold. This is why you really need to work with a financial advisor, with a tax advisor to understand what the tax implications may be on a certain transaction. But for many, this may be a time to diversify some of your assets and potentially take advantage of a lower capital gain tax rate. The standard deduction. So some people itemize their deductions, right? They'll deduct your charitable contributions, maybe your real estate taxes, some miscellaneous deductions. But most people take the standard deduction. And if you take a look at the middle line there, a married couple filing jointly will have a standard deduction of $32,200. Basically, about 9 years ago, the Tax Cut and Jobs Act doubled the standard deduction. And the legislation that passed last year extended that high standard deduction of $32,200. With the standard deduction being this high, about 90%, 92, 93% of taxpayers simply take the standard deduction because it's more than what they can otherwise itemize. So let me give you a couple examples. I talked about the standard deduction, I talked about the senior deduction, I talked about the charitable contribution deduction. So let's take a look. I'm going to just use the married filing jointly example, and that's going to be kind of in the middle of this slide here. Let's assume you got a married couple filing jointly. I'm going to assume they're both over age 65. And let's assume their gross income is $150,000. Well, they take the standard deduction of $32,200. By the way, since they're over age 65, you get something called a 65-year-old deduction. Between the two of them, that's an additional $3,300. Then you get that senior deduction I mentioned before, that's $6,000 per person, so $12,000 for a married couple. And let's assume they gave $2,000 to charity. So you start adding these new standard deductions or the increased standard deductions, the new senior deduction, the new charitable deduction. You'll see in this example, their taxable income is $100,000. Their gross income was $150,000. Their taxable income is $100,000. That means they're in the 12% tax bracket. So I think there's going to be some opportunities here that you can work with your advisor to potentially further reduce your taxable income. Now, in the capital gain rates, same thing here. Let's assume married couple just under $150,000. they take the same deductions. You'll notice that their taxable income is now 98,900. That means any capital asset they sell that's long term will be subject to no capital gain tax. Now, the more you sell, that can push your income up higher, and then that can push you back into 15% capital gain rates. But this is something to consider. Okay, let's talk about estate taxes and gift taxes. And I'm just really talking at the federal level. 18 states plus the District of Columbia has some sort of an estate tax or inheritance tax. Some have both. I'm really going to talk about the federal estate tax. The federal estate tax exemption this year is $15 million per person. So, married couple has a combined estate tax exemption of $30 million, which means if you die, my wife and I die, and our estate's under $30 million, we'll pay no federal estate tax. Now, with the estate tax this high, estate tax exemption this high, a lot of people aren't really motivated to do any real estate tax planning. And this has changed over the years. As Duncan mentioned, I started my career as a lawyer 35 years ago. And when I was a lawyer 35 years ago, I really concentrated on estate planning. Back then, the estate tax exemption was $600,000. And if your estate exceeded $600,000 and you died, you had a 55% federal estate tax above that threshold. You think about it. You had a home and your 401k plan, a lot of people were potentially subject to an estate tax back then. All my clients had an estate tax plan. They all had a life insurance trust. With the estate tax exemption being this high, a lot of people say, hey, I don't have to worry about federal estate taxes. But you know what, though? You still need an estate plan. We're in the midst of the greatest transfer of generational wealth in the history of our nation. Over the next 15 to 20 years, it's estimated over $100 trillion will pass from one generation to the next. 70% of that will be from the baby boom generation to Generation X. And then Generation X will replace the baby boom generation as the generation with the greatest amount of wealth. And despite the fact we have all this money transferring from one generation to the next, 62% of Americans don't even have a simple will. And this is where I really encourage people, hey, make sure you have a will. Make sure you have an estate plan. Even if you don't worry about estate taxes, you want to make sure that your wealth, your estate, passes to the next generation in the way that you want it to, at the time that you want it to, and the most efficient manner. I know a lot of people, sometimes me included, you'll draft an estate plan, you'll put it into a drawer, and you forget about it. You need to review it from time to time. You got to make sure it's up to date and it reflects current law. Okay, let's talk a little bit about Social Security and Medicare. And I'm going to ask a rhetorical question here. How many people here think Social Security is going to go away? And a lot of times people will say, if this was a live audience, I would probably get some hands up saying, no, I think it's going to go away. Matter of fact, I mentioned before, if we don't see any changes to Social Security by 2032, the so-called trust fund will be depleted. So let's talk about some changes. Let's talk about the health, the history and the health of Social Security. I think it's important to kind of set the stage here. Social Security was created in 1935. And in 1935, you were entitled to your full retirement benefit at age 65. Now, in 1935, what was the age expectancy? What was the life expectancy back in 1935? It was 65 years and 8 months. So the average American would get about 8 months of benefits before they passed away. So when Social Security was introduced in 1935, it was a pretty healthy system. 1950, you had 15 people paying into Social Security for every one person receiving benefits, which means you had 15 workers supporting each retiree. Again, pretty healthy. Now it's 2 to 1. And with the aging demographics, soon you have more people drawing from the system than actually paying into the system, which means if we don't see any changes in 7 years, that Social Security could be depleted. And if it is, we'll only pay about 80% of those promised benefits. Now, will we see some changes? I hope so. Let's talk about a couple of those changes are going to be, but I think what's going to be really interesting coming the midterms later this year, there are going to be senators who are elected or reelected, and they get a 6-year term. So it could very well be within that 6-year term, they're going to have to contend with Social Security and and potentially some changes. So let's talk about some changes, and whether or not any politician will have the political appetite to introduce these changes. But some things we may see is maybe change the retirement age. Again, 1935, the full retirement age was 65. Now it's 66 to 67, depending on when you're born. So over the last 90 years, they've only increased the retirement age by 1 or 2 years. Maybe you change how the Social Security benefits are funded. They're funded through a payroll tax. So we pay a payroll tax of 6.2%. The employee pays that up to the taxable wage base, which is about 180,000 this year. And the employer will pay another 6.2% up to that taxable wage base. So if we change that, for instance, let's assume we increase it to 7.2%. Not a popular proposal, but just that one change alone would extend the life of Social Security, some estimate by 20, 30 years. I mentioned the payroll taxes based on on your taxable wage base. So what does that mean? That means you pay that 6.2% payroll tax up to a certain threshold. This year is about $180,000. Above that, you don't pay that tax anymore. What if we uncapped it? Kind of like what we do with Medicare payroll tax. If we did it on all your income, all your earnings, all your wages, that could extend the life of the Social Security by 40 or 50 years. Now, that won't be a popular change, but there are things that they can do to extend the longevity of Social Security. Make the benefits means tested, change how it's adjusted for inflation. So just keep your eyes on what we could see. And I've been saying this for 2 decades, so we'll see if anything happens. But those are things that could be discussed. Now, what changed this year? Those who are receiving Social Security, the benefits were adjusted for inflation, so a 2.8% increase on your benefits. So that's welcome news. Arguably slightly less than what inflation actually is. They changed the taxable wage base. I mentioned before, that's what you pay the payroll tax up to. So this year's actually $184,500. And then another change, and this is kind of only going to impact some people. And these are going to impact particular people who are covered by a pension plan that don't have to pay Social Security. And that really is going to be teachers, police officers, firefighters. So in the past, any of those type of workers that were covered by a pension plan, they're in a certain pension plan, it's called a non-covered pension plan, which means they did not have to pay Social Security. If they are otherwise entitled to receive benefits, either because they worked in the private sector at one point in time, or maybe by way of their spouse or spousal benefit or a survivor benefit, those benefits would have been reduced. There were 2 provisions that went away last year. And this could be a windfall. And the example I like to use is my wife. My wife is a high school teacher, been a high school teacher for a while. And because she's a high school teacher, she did not, and she was covered by a pension plan provided by the Massachusetts Teachers Association. And because of this type of plan, she did not have to pay Social Security. Any benefits that she would have received by me, by way of a spousal benefit or when I die as a survivor benefit, those benefits would have been reduced probably to 0. That changed this year. So now she'll be able to get a benefit from Social Security based on my earnings record. So that's kind of a new windfall for us. And we have to adjust our retirement income plan to account for that kind of new sources of income that we could anticipate in retirement. Medicare, we're in open enrollment season now. So this is the time that you may want to think about, hey, do I want to change my coverage? Maybe I go from Medicare Advantage to original Medicare or back and forth. And that's going to be the end of next month. Your Medicare premiums will vary depending on what your modified adjusted gross income is. So if you're a joint filer and your modified adjusted gross income is less than $218,000, you'll pay the smallest premiums for Part B Medicare at about $202 a month. As your income increases, those premiums will increase and can be as high as $689 a month. And just because you're paying more premium doesn't mean you're getting better coverage. So, are there strategies that you can implement to help reduce your modified adjusted gross income? And this is things that you may want to talk with your financial advisor, with your tax advisor, but there are strategies that you can implement, that potentially reduce your modified adjusted gross income, reduce your taxable income in retirement, which then can have that cascading effect of reducing the taxation you pay in Social Security and reducing the premiums you pay for Part B and Part D of Medicare. Okay, let's talk about some retirement-related changes. And I'm going to cover this pretty quickly here, but every year you can contribute into a 401k plan if you're working up to a certain threshold. Last year's 23,500, now it's 24,500, so it went up $1,000. And this is, you can do it in a pre-tax bucket, you can do it in a Roth bucket in your 401k plan, but you want to make sure that you're maximizing the contributions if you're still working and contributing to a retirement plan. If you're over age 50, you can do what's called a catch-up contribution, an additional contribution. This year's $8,000. If you're 60, 61, 62, or 63, or will turn 60 this year, you can do what's called a supersized catch-up contribution. Instead of $8,000, it's $11,250. Now, why those 4 years only? I have no idea. Just for those ages 60 to 63, be aware that you could potentially get more money in your 401k plan than you could in prior years. With IRAs, the limit this year is $7,500. That went up. If you're over age 50, it's another $1,100. And one thing I like to point out here is one of the things you have to have earnings to contribute to an IRA. The one exception is if there's one non-working spouse. Well, as long as one spouse is working, if there's a non-working spouse, that non-working spouse can also contribute another $7,500 or $8,600 into an IRA. Right? So I want to make sure people understand that, because in the past, I know some people say, well, I'm not working, so I have no earned income, I can't contribute to an IRA. Well, if your spouse is working, and even though you're not, you still could potentially contribute another $7,500, $8,600 into a spousal IRA. One thing that changed this year, I mentioned catch-up contribution. So if you're over age 50, you can do an additional catch-up contribution. In the past, you can put that catch-up contribution into a pre-tax bucket or a Roth bucket. Beginning this year, if your income, your salary from your employer sponsoring that 401k plan is over $150,000 last year, doesn't mean all your income is $150,000, but what you get paid from that employer that's sponsoring that 401k plan, if that was more than $150,000 last year, any catch-up contribution you make will have to go into a Roth bucket, which means it's after tax. In the past, it could be pre-tax. If you're doing a catch-up contribution and your income exceeded that threshold last year, that means your taxable income would go up, because now this will be made on an after-tax basis. Another thing that you may be hearing about in the news is the so-called baby bond account or Trump account or MAGA account. And basically, what's this? This is part of the One Big Beautiful Bill Act. And any child born last year through 2028, so January 1st, 2025 through the end of 2028, the government's going to put $1,000 into this Trump account. And then the parents or grandparents or whoever can contribute another $5,000 a year into this account. It will track an index fund. So think about the S&P 500, for instance. And then when the child turns 18, it will become an IRA. And I think, and then it's used for qualified expenses like healthcare costs. If it's used, not healthcare costs, educational expenses, first-time home buyers, start a business, then it'll be taxable, but there'll be no penalty. If you use it for any other purpose, there'll be a 10% penalty on top of it. The reason why I bring that up is if you want these accounts to be used for those qualified reasons, educational expenses, first-time home buyers, they're better accounts to use. A 529 account, for instance, will grow tax-free, pay out tax-free for qualified educational expenses. A Roth IRA could be used for a first-time home purchase, and that distribution would qualify as a tax-free, penalty-free distribution. So if you're thinking about funding these Trump accounts for those reasons, they're better accounts to use. But I think the opportunity here is if you really want to help your child or grandchild who newly born kind of pre-fund an IRA, boy, this could be a real great opportunity to get money into this account, 5,000 a year, age 18. There could be quite a bit of money in that account for that 18-year-old. And that 18-year-old just leaves that money alone until they retire, growing tax-free potentially, if they do a Roth conversion. That could be a really powerful strategy for those new children. Oh, yeah, and then I'm going to just kind of spend a few more minutes here and kind of talk about the importance of doing an annual review. And I'm sure you do this, but if you're not, make sure that you're making an appointment with your financial advisor and kind of review. Let's do a review of 2025. Were the returns what I expected? Has certain accounts grown, so I need to rebalance that portfolio? Has my risk tolerance changed? Am I getting closer to retirement? So I need to adjust my risk tolerance and therefore adjust how my accounts are balanced. Have my retirement goals changed? Do I have enough money in my emergency savings accounts? Have my educational saving goals changed? No other saving goals. So again, have that conversation with your financial advisor. If you are approaching a certain age, be aware you might have to start taking required distributions from your retirement accounts, your 401ks or IRAs. Once you turn 73, you're going to take an RMD. In a few years, though, that's going to increase to 75. So make sure you're taking those because if you don't take them, there could be a 25% penalty on the shortfall. So make sure you're doing that. And then do a beneficiary audit. I mentioned before, we're in the midst of the greatest transfer of generational wealth in the history of our nation. And even though you may have an updated will and trust, many of your assets, for a lot of you, if not more, most of your assets are going to pass not pursuant to the terms of your will or a trust, but really pursuant to the beneficiary designation form for your accounts, for your life insurance policy, for your 401k accounts, for your IRAs, for your non-qualified annuities, and other investment accounts. Make sure they're up to date. Even if you have your will and trust, that's up to date. You can't ignore that beneficiary form. This, for many people, is the most important estate planning document usually overlooked. Back when I was an attorney, I certainly would take time to review my clients' estates, draft their wills, draft their trusts, make sure they reflect current law. I did not, as a practicing attorney, review those beneficiary designation forms. I think this is something you really need to do with your financial advisor. And do that review not just for the accounts the advisor is managing for you, but all your accounts. Make sure they're updated. Make sure you have a beneficiary designated. If you don't have a beneficiary designated, what usually happens is that account is going to have to be liquidated in 5 years, subject to probate. These assets, IRAs and 401k accounts, they're not subject to probate. And now if it's forced into probate, you're forcing in the time and cost associated with probate. So make sure you have a beneficiary designated. Make sure it's up to date. Make sure you have the right beneficiary designated. I know that seems kind of silly. I almost made this mistake. 35 years ago, I got my first job. I opened up an IRA. I put a few $100s into that IRA. I forgot about it. Completely forgot about it. It's still a small IRA, but I found it a few years ago. And then I realized I had my old girlfriend listed as a beneficiary. My wife would have killed me if I wasn't already dead. So make sure you have a beneficiary. Make sure it's updated. And if there's been any life event changes, right? If there's been a marriage in the family, a death, a birth, a divorce, make sure that's up to date. Okay, so I cover a lot here in a short period of time. I certainly want to leave time to take some questions, but hey, every year there are going to be changes. There are going to be new rules. There's going to be legislative changes, tax changes. And I think every year, part of the annual review is, hey, have a discussion with your financial advisor, with your tax advisor. How are these change? Could these changes impact me? Or are there some strategies I should consider to either take advantage of these changes or mitigate the cost that it could be on me because of these changes? So, Wesley, I'm going to stop it there, and I'm going to stop sharing, and then I'm going to turn it back to you. And obviously, if there's any questions, happy to, any questions I can. Just a big disclaimer here. Although I am technically an attorney, I no longer practice law. I'd like to tell people I'm a recovering attorney, not fully recovered yet. But I can't give any legal advice. I can't give any financial advice. I can't give any tax advice. But I will encourage you to talk to the experts that you work with, and I'm sure they can help you. But any high-level questions, I'd be more than happy to answer this time.
Yeah, so if anyone has any questions, towards the right side of the center, you'll see the question mark and Q&A box. If you have anything, you can feel free to type in any questions there. But in the meantime, Brandon, just a couple of questions that I have for you is, one of the questions we get these days from clients is, the hot topic of Roth conversions. Some of the things is, what makes sense. It's a very hot dinner party topic, and we just want to say, what are some of the considerations clients need to take under consideration before actually thinking of doing it?
Hey, that's a great question. And I'm a big fan of Roth conversions. I do a little bit each year. And the amount I do, I kind of take a look at, hey, what's my tax bracket? Maybe I'll convert an amount that push me up, use up that tax bracket, and not push me into the next one. That's going to vary from time to from people, person to person. But by doing Roth conversions, you're doing a couple things. You're reducing those required minimum distributions I talked about before, right? But there are no RMDs in Roth accounts. You are potentially reducing your taxable income in retirement, right? Because distributions from Roth accounts come out tax-free. And if you're reducing your taxable income in retirement, then you're potentially reducing the taxation you could pay on Social Security, reduce the premiums you pay for Part B and Part D of Medicare. But I also talk about the current tax environment we're in. I would suggest to you, Wesley, that we're in the lowest tax environment we've been in a generation. And I know some people will say, wait, what about the 80s? The top tax rate was 28%. Now it's 37%. That's true. But back then, you got to 28% a lot faster. So for many people, this is going to be the lowest tax environment they've been in a generation or so. And if you think taxes are likely to go up, and I'm sure if I asked everybody who's participating, raise your hand, do you think taxes eventually will go up? I think most people say, yeah, they will. When? I don't know. How much? I don't know. If you think that, hey, this might be a good time to take advantage of the lower tax environment and hedge against real risk of higher taxes in the future. I know some people are doing tax conversions for estate planning purposes. My mother and my stepfather have, because they figure, hey, I'll pay the tax on this account so my kids don't have to, because my kids are in a higher tax bracket anyway. And then that's going to grow tax-free for my kids. So there are different ways and reasons to do it, but keep in mind, you got to pay the taxes, right? So how much are you willing to pay? Again, what I do is I do a little bit each year. A little bit will vary depending on my tax situation.
Okay, wonderful. Thank you for the insight, Brandon. Mehul, go ahead.
I have a question in case anyone else doesn't have one yet. Brandon, you may have touched on this. I was a little distracted because of my kids. But are there some low-hanging fruit planning techniques that you think that are maybe eliminated for when it comes to tax avoidance, considering what our national debt levels are? Do you think that there's going to be some things that the government may hopefully grandfather, but going forward may not be opportunities that we'll have going that to be able to take advantage of?
Yeah, that's a great question. I get that question every year. It's so hard to answer because you kind of use a crystal ball. What could we change? What could we see? I will tell you a few years ago, I really thought the whole backdoor Roth idea would go away. The mega backdoor Roth, and basically what this means is sometimes you're allowed to contribute what's called after-tax money into a non-deductible IRA and then convert that to a Roth. Or really max out your after-tax contributions in a 401k plan and convert that to a Roth and potentially doing it to a tax-free. And this will really benefit certain people. But then you think about all these accounts that can grow tax-free for a generation or more. Are you losing revenue? So could you see that door close? Potentially. I thought, quite frankly, I thought a few years ago that would go away. It didn't. So I tell people, hey, get while the getting's good, because that's something we could see go away. And I don't want to get too technical when I don't want to lose too many people here, but that's a conversation to have with a financial advisor. Hey, Brandon mentioned this. Does that make sense for me? Should I consider doing that? Will that go away? I don't know, but it could.
Thanks.
Yeah.
All right. We have one question that mentions, Brandon, most of your presentation dealt with the younger age group. Anything to add specifically to the old geezer group? Your presentation made us realize that we do not want to have any more children at this time.
That's a great question. Well, I mean, again, a couple of things that will apply to older folks. I mentioned before that senior deduction. So if you're over age 65, you're going to get another 6,000, 12,000 if you're married. That's a big change. Make sure you take advantage of that. Even if you're retired, Roth conversions may make sense. Matter of fact, I would argue for many people, it's the right time to do it because your earnings, your taxable income could be down. So maybe I start doing Roth conversions now, and that way I'll have that go tax-free for later on, or maybe I'm doing it for legacy planning purposes. So yeah, there are always things to do. Also, how tax efficient are your investments? All right. Let's take a look at our 1040. Are we paying a lot of income, interest income? I'm going to use interest income real quick. Over the last several years, with market uncertainty, market volatility, there has been a rush over to cash. When I say cash, I'm talking about CDs, money market accounts. And for many, it makes sense, right? Rates went up. I'm getting 5%. So maybe I'll go there because market seems a little uncertain. Well, those rates are coming down now. And if you're paying more and more money on your interest income, I think let's have a conversation. What's the realities of investing in cash-like accounts long term? I would suggest probably not the best thing. Are there alternatives that I can invest that maybe on a tax-deferred basis, where I can participate in the market, have upside potential of the market with downside protection? Those are solutions and strategies your financial advisor can share with you. So tax-efficient investing, tax deferral, I think that would apply to everybody, regardless of age.
Hey, Brandon, just to dovetail on that, a couple quick questions, hopefully, that you may be able to touch upon. When it comes to the Roth conversions for those that are 65 and over, I understand that you mentioned that you're doing some smaller conversions, depending, smaller is all relative for any individual family. But what happens if it affects the Medicare Part B premium type situation?
Yeah.
But if it's an anomaly situation that, let's say, the client wants to do a conversion in 1 year, 2 years down the road, it's going to affect that. But it was really just a 1 year situation.
That's right. So if I do a Roth conversion, that could be a tax liability, right? By the way, I'm going to use an example here. If you do a Roth conversion and you pay the taxes with money out of your pocket, which is what you probably should do, you're kind of doing a catch-up contribution into that account. And an example I like to use is this. Let's assume I have a $100,000 IRA, and I'm the 35% tax bracket. What's that IRA really worth to me after taxes? Well, if I liquidate that $100,000 IRA, I got to pay taxes on it, right? So $35,000 goes to the IRS. I'm left with $65,000. If I convert that $100,000 IRA and I pay the resulting tax liability with money out of my pocket, I just gross up the value of that IRA from $65,000 to $100,000. In other words, I kind of did a $35,000 catch-up contribution, right? I took $35,000 out of my pocket and basically put it in an account that's going to go tax-free. Now, I need to have that $35,000 to pay that tax liability, right? And that's a consideration. Do I have that money to do so? If you don't, probably not a good thing for you to do. But if I do, well, I just increase my taxable income that particular year, which means, as I mentioned before, my modified adjusted gross income goes up for maybe just 1 year. My premiums go up, so that might be a 1 year cost. But you got to consider that, right? That can increase my Social Security taxation, but it might be just for 1 year, where the long-term benefits of that going tax-free for years, decades, or even a generation certainly might be worth it. But it's a numbers game, right? Does it make sense for me? But those are considerations. I'm glad you brought that up.
You know what? And I'm glad that you brought up the two different ways that you can do the conversion, paying out of pocket, which is the preferred method, instead
Yep.
of paying out of the IRA at
Yep.
conversion, because then, we have to make up that much more in return to get back to break even and then
That's
outpace
right.
that. One last question that I have, that we've gotten now over the course of the last couple of years, and it's based on making charitable donations. Majority of our clients no longer are itemizing; they have the standard deduction.
Yep.
So, do you think that it makes more sense if they're over the age of 70, 72, 73 that they're taking RMDs, if they're charitably inclined, the concept of qualified charitable distribution?
Yeah, so you're right. So that's called qualified charitable distribution. So let's assume I'm subject to RMDs and I'm forced to take these RMDs, don't want to, have to, right? And are there things I can do? One is, to your point, is this qualified charitable distribution. For those that are charitably inclined, who don't otherwise need that RMD, you can contribute money make a qualified charitable distribution directly to a charity, up to 111,000 this year, and that'll satisfy your RMDs as well as making your charitable contribution.
Wonderful. Any last minute questions from anyone in the audience? But thank you, Brandon, for your time and insight with all these updates. It's a lot changing on an annual basis, and you're the one on the forefront, reading and understanding everything to provide this education to not only the audience and the clients, but to us, the advisors, at different events as well. So it's always appreciated for your insights and your partnership with Prudential and Secure Planning. And Mehul, I think you have some closing remarks for the group.
Yeah, I think that Duncan and Brandon, if we were all meeting together, uh, you'd get a rousing round of applause from all the members that were able to take some time out and join us. I thank you on behalf of everyone at Secure Planning. Thank you again, as Wesley mentioned, your insight, your intelligence on this topic. We wish you the very best in Boston. Stay warm. And just as a reminder to everyone, we're going to be having another webinar on April 22nd evening at 7 p.m. The concept is going to be on cybersecurity. I think that we may also touch on some other forms of security. I was just hacked last week, so I'm trying to figure out what I need to do to make sure that I can create a better shield around me moving forward. I think it's a very hot topic that many people are going to be affected by. I hope you understand why we ask a lot of questions when we meet for our reviews, whether it's face to face or if it's by Zoom or even if it's a phone call. There's a lot of information that we need to collect that goes above and beyond just the performance of the investments that we have. So with that, I will, you know what, there's also a reminder that as you're all signing out, you're going to get 2 questions. If you don't mind, please answer those questions about the topic of this presentation and what other topics would you like to hear about in the future. We'd really find that helpful for us so that we can bring all of you the content that you really would like to see in things going forward. Eleanor, anything else?
No, just want to thank Brandon and Duncan again for your help and support. Thank you very much. Everyone, have a good evening. Thank you.
Thank you.